All right, what up, YouTube? Welcome back to the channel. Another episode of Chasing the Come Up. This is my crypto coaching mini series. You guys ready to dive in? Let's get it. We're going to talk about basic chart patterns. So this is going to be like a little 3-part mini series, just focusing on different charts and formations. So I want to start at the absolute basics and then dive in and go from there. So let's dive in. Let's get it. All right, squad, so I'm going to do a little spiel. If you guys want, go ahead. There's going to be a skip ahead timer. Just skip ahead about a minute if you guys don't want to hear this little intro part. But I just made the most amazing tutorial all about bullish divergence and bearish divergence. So if you haven't had the chance to check that out, and you don't understand how bullish and bearish divergence works, for example, when price is making lower highs and RSI is making higher highs, you're most likely going to see price reverse and push towards the upside. If you guys don't understand how divergence works, in my opinion, divergence is the absolute best indicator when trading crypto. Now, if you mix divergence with chart patterns, it's all about adding as many signs of confirmation as you can to a trade. That way, you're going to have the highest probability of being successful as a trader. So chasing the come up. Chasing the come up is just my way of like just going after it. You know, if you want to be a trader, do it. Chase it. Chase that dream. So let's chase it. We're chasing the come up, right? Crypto coaching mini series, mastering chart patterns. So this is going to be a 3-part mini series. We're going to talk about bullish versus bearish, flags, pennants, rectangles, wedges, double bottoms, triple bottoms, double tops, triple tops, cup and handles, and head and shoulders. These are the most important patterns that you can see when trading crypto or stocks for that matter. But just to get started, we're just going to talk about flags, pennants, and rectangles. So let's dive in. Let's get it. And of course, if you guys have not watched my BYBIT training tutorials, you guys can check it out. You can actually set up a test account on BYBIT testnet and actually trade crypto on a legit exchange, but it's just a dummy exchange. It's almost like paper trading, but better. So you can actually practice leverage trading. All my discount codes are down below. Check them out. Absolutely love BYBIT. It's my favorite exchange. So the following chart patterns are the most recognizable and common chart patterns to look out for when trading using technical analysis. Again, this is just part 1 of 3. So the patterns we're going to talk about right now, we're going to talk about double tops, double bottoms, bullish pennants, bullish flags, bearish flags, bullish triangles. So when we're talking about a double top, what they are talking about is price coming up, pushing to the upside, making a high, then reversing down, coming down, finding support, pushing back up, and double topping. Double tops kind of let you know they're one of the first indicators that price might be reversing in the opposite direction. Why is that? Because the bulls tried to push price up. It could only go so high, and when it gets to this certain point, the majority considered that the price of that cryptocurrency was overvalued, so a majority started to sell, and that's what drives price down, and then price comes back up. When it double tests that same high and gets rejected, that's definitely not a good sign. That's definitely bearish sentiment in the market, and more than likely, price will continue to come to the downside. Now, if you flip that around, price is coming up, finds up, hits a high, comes down, finds support, pushes up, gets rejected, comes back down, finds support, pushes up, and breaks out. And you can see the pattern that we're actually looking for here is the W and the M pattern. So double tops, double bottoms. A double top is another pattern that traders use to highlight trend reversals. Typically, an asset of price will experience a peak before retracing back to a level of support. It will then climb up once more before reversing back permanently against the prevailing trend. And then double bottoms are the same thing, the exact opposite. Again, I cannot stress this enough, guys. When using these patterns, especially for trading crypto, if you are trying to trade just based off a pattern, I promise you're going to fail as a trader. This is just one more sign of confirmation that you can use to become a better trader, but you should always be using multiple things like triple tops and bullish or bearish divergence, RSI, overbought, oversold, all of those things. So just like a double bottom, a triple bottom, or a triple top indicates the same thing, but a triple top, in my personal opinion, is even more likely going to result in a true push to the downside. At 3 different times, the bears took over, they pushed price back down, and no matter how hard the bulls kept trying, they couldn't actually break out above. Now, a triple bottom, definitely the same thing, but whereas resistance will hold, every time you come down and test support, it's less likely to hold. So if you were to have a quadruple bottom more than likely will result in the opposite because you're coming down to test that support and then it fails. Whereas a triple bottom is definitely a good bullish indicator. So the next thing we're going to talk about is we're going to talk about bullish pennants versus bearish pennants. So pennants are represented by 2 lines that meet at a set point. They are often formed after a strong upward or strong downward moves where traders pause and the price consolidates before the trend continues in the same direction. So let's check these out. So one thing I'm going to say about pennants in these formations, right? No matter how the charts look, there is literally a formation for everything. So no matter what, as a trader, I think a lot of this stuff kind of just confuses you, but at the same time, it does have value. So if you take a look at a bullish pennant versus a bearish pennant, you can see the bullish pennant, price pushes to the upside, gets rejected, comes down, finds support, and then price right here starts to make higher lows. But at the same time, you're also making lower highs. So price is kind of consolidating and it forms this pennant formation. If price comes over here, pushes in from the upside, gets rejected, comes down, finds support, boom, boom, bounces down, and then blast off out of the zone. Now a bearish pennant, same thing. Price is coming down, and then boom, 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 and then price pushes to the downside. So when you're talking about pennants, if you see a pennant forming and price was coming up from the upside and price was pushing up and then formed the pennant, you're looking at a bullish pennant. Now if price is coming in from the downside, does the same thing, bearish pennant. It lets you know, it's just an indicator that price is going to continue and that trend is going to continue in the same direction. So who can tell me what type of pennant we're forming before we actually form it? I wanted to make these little animated videos for you. So we see price coming up, pushing to the upside, right? So what does that tell you? If we're pushing up from the upside, more than likely we are making a what? Bullish pennant. So we find out here we're making higher lows over here, making lower highs, pennant is formed. Where is the trade? So you see price making higher lows and lower highs. Boom, right here. Do we take this trade right here? Is this where we trade it? How would you trade this pattern? Where would you place your stop loss? Where would you place your take profit? So this is our bullish pennant. We see price coming up in here. Wait for it. Price makes a top. Price reverses. Bam. Down here to the downside. Price pushes up again. Tops again. Starts pulling back. Do we look for the breakout trade? Are we trading this breakout? So here's our take profit. Here's our stop loss. When do we enter? Do we enter on trend break? Nope, we do not. We wait for price to come back down here, find support on this downtrend, and then make a push to the upside. So we enter when the trend confirms support and bam, price reverses and blasts off to the upside. We normally want to set our take profit just below the lower trend line, assuming that price is going to continue to stay trapped and not break this downward trend. So we can easily enter our stop loss right down here. We wait for price to break out of the zone, breaks out of the pattern, right? Comes up here, finds a peak, reverses, finds support on this trend line, on the upper trend of the pennant, and then blast off to the upside. This is our entry point. Our stop loss is normally, it doesn't even have to be more than like 1 or 1.5%. And that's your zone. That is your breakout trade. Price reverses, finds support, and then starts to massively push to the upside and break out. We want to enter as low as possible with a stop loss as tight as possible. So now that you understand the game and how it's being played, same thing here. We have a bearish pennant. So when we see this formation playing out, how do we trade this type of movement? So let's check it out. We got a bearish pennant. We know so because price is coming down from the upside. Finds bottom. Starts to push back up. Price gets rejected again. So now we have price making lower highs. And we also have price making higher lows. We can see our first trend is formed. What do you think this is right here? We already know. Now where do we set our stop loss at? Bam, right here. Right above this trend line, right? Because we're assuming that price is going to come up, get rejected on this trend, and then start looking to make a push back to the downside. But we don't know until we have confirmation. So when price comes back up here, test that trend line, price reverses, starts to push to the upside, bam, that's our entry point. Our stop loss is right here, and price is right here, just above that breakout candle. That's our stop loss. And our take profit normally is about 3 to 4 times our stop loss if we're scalp trading. So it just depends on how you're looking to trade. You know, your take profit can be drastically different than mine. We can both win the trades. You know, happy days, happy days. So you have bullish flags and you have bearish flags. The flag stock chart pattern is shaped as a sloping rectangle where support and resistance lines run parallel until there is a breakout. The breakout is usually the opposite direction of the trend lines, meaning that this is a reversal pattern. So flags, in my opinion, they're so hard to actually trade and actually spot when they're being formed, because at the same time I'm making higher highs, and then price is making lower highs. I'm actually thinking that bearish movement is going to be bullish movement push to the upside, but maybe, just maybe it's not. So you can see price comes down, bounces in here, and it starts to form this basic flag shape. So again, over here, we have the bullish flag. Price comes up in, gets rejected, which I don't get. Price starts making lower lows and lower lows, but at the same time, I guess that could be a retrace. Then it blasts out. So how do we actually trade this pattern? Same way as before. We see price coming down, gets rejected, finds support, boom, 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 bounces in this channel, forms the flag. Once the breakout happens, same way we traded the other patterns. Breakout happens, price comes back up, gets rejected on the flag trend line. Then once price is rejected, bam, that's our entry point right there. If price reverses right here and starts to push up in the littlest bit, that's our entry point, and we can have a really tight stop loss on it, 0.5%, 1%. We just want to make sure that if a wick comes back in here, we don't get wicked out, and then price will reverse and push to the side. Take profit. People use the analogy 3 to 1. Personally, I just like to monitor, and I think every trade's different, so I think that there should be no really, set in stone take profit. If price is really volatile on that altcoin of yours, you can't even have a 5% stop loss sometimes because the price is just so erratic and so unpredictable. But anytime you have to have more than a 3 or 4% stop loss, I think you're actually, fighting against yourself. If the trade goes in the wrong direction for 1 or 2%, personally, I think you entered the trade at the wrong time. Again, now we have the bullish flag. Same thing, price comes up, blast in, out, starts forming the pad. So we have the same thing over here with the bullish flag. Price bounces in, bounces around, forms the flag. Once we have that breakout trade, price comes back down, tests that local trend line there that our flag formed, and bam, blast off to the upside. Same scenario. Stop loss below the trend line. Entry point after we find confirmation and that trend confirms confirmation, price pushes up. Take profit as high as you want to set it. So next we have the bullish rectangle versus the bearish rectangle. Bullish rectangles are continuation patterns that occur when price pauses temporarily during an uptrend. They offer you the buying opportunity. You place the profit target at the same distance above the rectangle, upper resistance levels as the distance between the rectangles, 2 parallel lines. So let's go ahead and dive into it. Bearish is the exact opposite. So again, bullish, price is coming from the downside, pushing up. Price gets rejected. You have that double top almost. Price comes up, pushes in, comes down. And what do you start forming here? What pattern do you see here? We see our W pattern. Again, W bottom. Again, W, double bottom. Boom, boom, boom. Price breaks out. Bearish rectangle, price is pushing from the upside, comes down. Finds support, pushes back up, price gets rejected, starts to retrace, comes back up again, gets rejected. So you have that double top there, M formation, pushes to the downside. Now you have what's called the bullish rectangle. Same thing. Where's our entry point at? Bam, right here. Once price breaks out, comes down, retests, shows us confirmation that we are right to take this trade, and boom, blast off to the upside. Entry here, stop loss just below this upper double top level, and bam, you're in the trade, you're good to go. Same thing, bearish rectangle, guys. Price comes down, finds bottom, pushes back up, bam, gets rejected, pushes down, bam, gets rejected again, breaks out, comes up to test, confirms, boom, bam, stop, entry, take profit. Let's get it. Get in, get out, take your profits, pay yourselves, guys. So there's the most important thing about trading any one of these patterns, never trade the pattern alone. Never ever in a million years should you be trading just the pattern. Always use patterns for additional signs of confirmation in combination with other indicators and other assets you guys use. If price of an asset starts to make a series of lower highs and RSI starts making a series of higher highs, this is often the sign that a downtrend will continue. Divergence is just one key tool in your toolbox. Same with patterns. Patterns are just one key tool in your toolbox. You should always look for multiple signs of confirmation no matter what. And then the best advice I can give you guys is don't take a trade just to take a trade. Wait for the trades that you want to take and take the trades that have the highest probability of being winning trades. There's going to be a million trades out today, tomorrow, the next day. I promise you guys that if you guys are not patient, you will never survive as a trader in the cryptocurrency world. All right, YouTube. So that's a wrap on chart patterns 1. Next, we're going to dive into ascending triangles, descending triangles, head and shoulders, reverse head and shoulders, cup and handles, some of the more advanced patterns that are a little bit harder to spot. I wanted to break this down into a 3-part mini series. That way it's not overwhelming and I'm not showing you guys too much all at once. So again, guys, if you guys aren't trading on BYBIT, I promise you guys are losing money. Last week alone, I was able to DCA into Pundy and set all of my DCA targets, $500 bankroll. All my limit buy orders are already set in place. I already started accumulating coins of Pundy, and bam. And I did that with $500 because I saved $500 because I trade on BYBIT. So every time I take $10,000 worth of trades, I'm making pretty much an extra $100. Whether I win or lose, I'm up $100 than I would be trading on a majority of the other exchanges. That being said, every time I make $10,000 worth of trades, whether I open a trade for 1 minute or 30 seconds, I'm still paying that fee because my bet was $10,000. Or if I do, $100 trades, then I'm at 10,000, same difference. Those fees will eat you alive. So why do I love BYBIT? That's just it. Everything about BYBIT's awesome on top of the fact they pay you to actually trade on that platform. And that's a wrap, YouTube. So thank you guys so much for stopping by the channel. Again, my name is Ryan Mehta. I appreciate each and every one of you guys. Links for all of this is down in the description. Divergence cheat sheets on my website. You can download them. You guys can download my DCA strategies. I got nothing but love for you guys. Thank you guys so much for supporting the channel. Hopefully you guys have a great day. Trade safe, crypto fam. Peace.